Good afternoon, everyone, and thank you for joining us. You are attending part 2 of the DBRS Morningstar U.S. Middle Market CLO 101 webinar series, with today's focus being on warehouses and financing facilities. My name is Stephanie Mah. I am a researcher in our structured finance group, where I focus on ABS and structured credit. I will be interviewing my colleague, Jerry Van Koolbergen, who is a managing director and head of structured credit here at DBRS Morningstar. Jerry, if you would please introduce yourself.
Yeah, sure. So, my name is Jerry, and I am responsible for structured credit. So that means we provide ratings on middle market CLOs, as well as the types of facilities that we're going to be talking about today. And I've been with DBRS Morningstar for about 13 years. Maybe I'll just, Stephanie, give a very quick overview of the stuff I'm going to be chatting about today. Does that make sense?
Sure, that makes sense.
All right, great. So last time we talked about 101 for middle market CLOs, and that's really the syndicated middle market CLO market, and that's the most visible middle market CLO market. Today we're going to be talking about some facilities that are more private, but whose analysis actually follows exactly the same protocols as we would follow for middle market CLOs. So these middle market CLO warehouses and financing facilities are an important CLO sub-asset class. In fact, these financing facilities, both in rated and in unrated form, have really helped to drive some of the volume increases and the increases in the assets that have been funded in the middle market space. Just given that these are very useful financing tools for middle market funds. So this private market is kind of a like I mentioned, it's a bit of a parallel CLO market, but it's parallel in that it's in some ways almost exactly parallel. It's founded on the same traditional CLO analysis principles for the facilities that are presented to rating agencies like ourselves for analysis, and it uses the same analytical tools. So we'll be referencing back to some of the topics that we discussed on the first middle market CLO 101. Thanks, Stephanie.
Great. And to give folks an idea of the roadmap, first we'll start out with a broad overview of the US CLO market in 2021, providing information on issuance trends with a focus on the middle market segment. Then we'll turn our attention next to providing a primer on middle market warehouses, starting off with the basics, including things like structure, duration, and portfolio composition. This will be followed by a discussion on middle market CLO-like financing facilities and middle market fund-related ratings. And then lastly, we will cap off the conversation with nuanced items that DBRS Morningstar has identified as important for investors to know. A couple housekeeping items. Please feel free to type in any questions that you may have throughout the presentation. You should see a question mark on either the right side of your screen or the bottom of your panel. We will address your questions at the end of the webinar. Welcome back for those that attended part 1 of the 101 series. It's worth noting that those who are unable to attend that session, there should be a link at the bottom of your screen for easy access to part 1 at a future time for your convenience. Now let's get started. As we mentioned a few weeks ago, US CLO volume this year has been quite robust, and that momentum continued throughout last month, but was primarily concentrated in broadly syndicated loans. New issuance year-to-date through the end of November totaled about $160 billion, more than double the amount seen in the same period last year. However, middle market comprises a significantly smaller proportion of the overall issuance at about roughly 10%, with BSLs accounting for the remaining lion's share. US middle market CLO issuance totaled about $15 billion year-to-date, spanning across 28 deals, and that's ahead of last year's pace in the same period with roughly $10 billion and 24 deals. Jerry, as you highlighted earlier in your opening remarks, private middle market CLOs use very similar structures and analytical techniques as syndicated middle market CLOs. I think it'd be helpful to describe middle market CLO warehouses, starting out with the definition and then maybe dovetailing specifically into how they compare with regular way syndicated middle market CLOs.
Sure. Yeah. Thanks, Stephanie. So a middle market CLO warehouse, not surprisingly, is a facility typically used to ramp up loans prior to issuing a syndicated middle market CLO. So most syndicated middle market CLOs are mostly or fully ramped by the time that they're marketed, maybe 60 to 75% ramped. And a warehouse facility typically comes before that to provide a ramp up for that portfolio. It's not surprising that the analysis here is going to be similar across both CLO warehouses as well as the syndicated CLOs, because they essentially comprise the same assets and the same dynamics. So having a different style of analysis there, probably not surprisingly, doesn't make a lot of sense. There are things that are different, though, and those are the things that we've kind of highlighted here on this page. And so we're going to talk a bit about those in terms of the typical structures, how the financing draws down over time, duration, and portfolio composition.
Given that the facilities are used to ramp up portfolios, I would imagine that the financing structures must be different somehow, with the financing for regular way syndicated CLOs typically being fully drawn at closing. How is a middle market CLO warehouse financing different, if at all?
Yeah, sure. The financing there really kind of changes over time, because the financing is drawn down over time. So the financing really grows. And you can see that same dynamic across both of the two typical CLO structures. So the two typical CLO structures for ramp up are, number one, things that are CLO-like, and then number two, things that are not CLO-like. So we broadly call those bank facilities here. But those CLO-like facilities have covenants and eligibility and collateral quality tests and concentration limitations that might follow things in a very similar way to middle market CLOs. The bank facilities, they might have a more flexibility afforded to them, so they might be a bit broader in terms of what they would permit in their documentation. But usually there is a decision maker, such as a bank lender or non-bank lender, who's reviewing every asset that's going into the facility. So there are controls over the types of portfolios that are accumulated in both of those facilities. It's just their guidelines are slightly different, and that means for CLO-like facilities, a rating agency like ourselves might be able to rate them. And for things that are bank facilities that are basically driven off of lender consent, that those are a bit more challenging to rate. So the financing over time there, in both cases, starts from almost zero and then ramps up to fully ramped over time. So that's different than middle market CLOs. That for syndicated middle market CLOs, the financing is fully drawn at closing, and the excess financing that isn't invested in assets is invested over the next 6 to 9 months. Here, there isn't that dynamic of excess capacity that's drawn down and then invested. The capacity to lend is drawn down as needed and as loans are identified.
Jerry, if I could jump in here, if the financing is changing over time, I assume the portfolio would also change over time. What impact, if any, is there on various components such as diversity, leverage, or other components that you identify as being important?
Yeah, sure. I think the portfolio changing over time creates an analytical challenge, but it still kind of fits into an analytically possible situation. So the portfolios might start out much more concentrated because there's only a handful of assets to start, and so there might be lower financing or less financing needed for that smaller portfolio, and even a smaller percentage of that might be rateable at the beginning of the transaction. But the portfolio, as it becomes more diverse, or as its portfolio parameters change, typically the amount of leverage might change over time. So, for example, if the portfolio diversity goes from very low to high over time, you'd think that the leverage there would actually increase and change. Lastly, I'd sort of mention that for facilities like this, the durations are quite different than syndicated middle market CLOs. So for warehouse facilities themselves, typically the ramp up is occurring over a year, maybe a year and a half in anticipation of a CLO. And then the expectation is that the assets are rolled over into a CLO. It's usually a negative event if a CLO is not able to occur. So that shorter duration can create an analytical challenge for rating agencies. But in general, you're going to see for facilities that are specifically designated as warehouse facilities, they'll have a shorter duration. How rating agencies might deal with that kind of depends on the facts and circumstances of the facility. But for leverage facilities that sort of terminate at the end of the warehouse period, a rating agency might need to be thinking about at what price, or is there a market value kind of sort of analysis that we might need to add to how we think about the likelihood that a debt instrument would be repaid. But there are ways and there are techniques for lenders and issuers to structure transactions that have much longer maturities in them that don't introduce market value risk that we might be able to analyze. So maybe just in kind of a short summary here, what is a middle market CLO warehouse? It's a facility used to ramp up a syndicated middle market CLO. There are two typical structures, CLO-like and not CLO-like. Their durations are typically expected to be much shorter than longer CLOs, and the portfolio composition is expected to change over time. And with that, potentially the rated amount of debt that a rating agency like ourselves could rate.
Jerry, with that backdrop in mind, I'm curious if there are middle market CLO warehouse-like financings that aren't necessarily used to ramp up a syndicated middle market CLO.
Yeah, exactly. So usually starting with an explanation of what a warehouse facility is for a syndicated CLO is an easier way to explain how a warehouse-like financing would work. So in the market, often folks will use the term warehouse financing when there isn't any CLO that's being warehoused for. And these middle market CLO-like warehouse financings are actually more prevalently rated than the actual warehouses that are being ramped up for CLOs. So very simply, there are a whole host of facilities that are warehouse-like, and they follow exactly the same sort of characteristics that I described before, exactly the same types of structures. It's just the end goal of that isn't to fund a syndicated CLO, but is itself a form of term financing. So middle market funds that are looking for financing options might look to the syndicated CLO market for leverage, or they might look to a bank partner for non-CLO-like financing, or they might look to club syndicate leverage to market participants in a CLO format. They might ask a rating agency like ourselves to rate those. But very, very, very simply, the middle market CLO warehouses and the CLO-like financings are exactly the same structure. So these first two structures that we've presented are essentially exactly the same.
And can those analytical techniques be used to analyze other asset types?
Yes, yeah. So warehouses and warehouse-like financing, we've been asked to rate things that have broadly syndicated loans in them. We've also been asked to look at various types of and subsets of middle market loans that you might not necessarily always find in syndicated middle market CLOs. So we've seen more stressed portfolios. You can see occasionally high yield bond portfolios. We might see second lien portfolios. So there are more bespoke portfolio compositions we might see in these warehouse-like structures. And those just sort of, that sort of makes sense because there might be specific middle market funds that might not be able to fund themselves or to raise leverage in the traditional syndicated middle market CLO space. So they are looked for options to fund or finance in maybe more bespoke or more club-oriented lending situations. And as long as those assets have assumptions that we could use in our statistical analysis, we should be able to analyze permutations of those.
Jerry, this seems like a natural break now that we've covered kind of the definition, the structure, and duration. Maybe you can summarize what we'll cover in the next couple slides.
Yeah, sure. So we're going to show here a graphic next on how this warehouse type financing usually works. And then we're going to talk about another permutation, or really another step in this continuum of analysis, which is fund-related ratings. And that's a topic that we've been hearing a lot more about, and one that we've published a rating methodology on recently. So if you step back and think about the funding or the financing options in the middle market space, there are syndicated middle market CLOs, where larger groups of investors are brought together to help finance portfolios of middle market loans. Those are often mid to the larger end of the middle market space, but there have been exceptions. There are bespoke versions of those financings, and those kind of fit into two categories. Ones who functionally are providing warehouses to the syndicated middle market CLOs, and essentially the same structures which are being used as term financings for middle market facilities. Lastly, at least within the structured finance space, facilities that are directly funding or financing funds, either with the fund itself raising debt or repackagings. That's sort of the next step in the continuum of potential structures here. And then lastly, you get to business development companies and really non-banks and banks themselves in terms of how middle market loans are financed. That entire continuum from left to right is essentially an arc that runs from a structured finance style of analysis to a corporate analysis. So we'll talk a little bit about how these portfolios kind of look and how they change over time, and talk a little bit more about the corporate end of the spectrum shortly.
That's a very comprehensive summary, Jerry. I hope you didn't steal your own thunder. And with that, let's turn our attention next to a visualization of these structures. You'll see on this slide, they say that, a picture is worth 1,000 words. Here we see an example that summarizes how this analysis is typically conducted. Jerry, please walk us through the diagram.
Yeah, sure. So here, I think this is very helpful to visualize to sort of get a sense for, how we might analyze these types of portfolios. So what we're showing here is on the x-axis, we have diversity, which is increasing as you go from left to right. And on the y-axis, we've got leverage that's increasing as you go from the bottom to the top of the page. And these three different snapshots of portfolios are showing portfolios in different stages of ramp up. So we've got kind of a lower ramped portfolio, a medium ramped portfolio, and then a more ramped portfolio. And for each of those, if we just took a snapshot of a moment in time and applied our CLO analysis to each one of these portfolios and the proposed structures that come along with it, the result of our analysis would be, not surprisingly, for lower levered portfolios, that for a given rating, there would be less leverage that would be permitted for those portfolios. And then as you move further to the right, as the diversity increases, you would be able to obtain a higher rating or higher leverage for the more diverse portfolio. And then lastly, in the higher leveraged state, you would be able to achieve the highest amount of leverage. So thinking about how a rating agency like ourselves analyzes these warehouse facilities, which change with a much greater variety than a fully ramped syndicated middle market CLO. It's like we're taking a snapshot of each of these stages and analyzing each of them individually. So if you understand how a rating agency like ourselves rates a middle market CLO or a fully ramped CLO, you can think about our analysis for a warehouse or a warehouse-like facility to be essentially looking at each individual stage and rating those different stages. So this graphic here shows that diversity is the primary variable that drives analysis, but that doesn't have to be the case. It seems like a good place to start because baseline, as you're wrapping up a portfolio, it will almost always become more diverse. But there are other elements that are primary drivers to a rating agency's analysis: credit quality, the recovery, the duration, the weighted average spread. These are all elements that could also potentially change over time, and those are levers of optionality that issuers might use as a portfolio ramps up in order for them to help structure transactions that they would present to us to be rated. So what we analyze is the end of that process, and the end of that process is a matrix covenant. So that's a matrix of covenants that are required metrics on the underlying portfolios, and given each of those metrics, each of those expressions of the matrix is something that we can analyze. So that kind of rolls back into the original description that we can rate each aspect or each element of a potential matrix of covenants. So if we just add like a third dimension here, credit quality, a lower diverse portfolio with a higher credit quality might be able to achieve either a higher rating or higher leverage than you might if you had a lower diversity portfolio and lower ratings. So each of these things are analyzable. Almost every permutation of credit risk, diversity, weighted average spread, seniority of the underlying portfolios, each of those is an analyzable element. So as long as there is a defined progression in the underlying covenants, then it should be something that a rating agency like ourselves should be able to analyze.
Okay, thanks for that recap on our analysis, Jerry. It's worth pointing out that the DBRS Morningstar predictive model, known as the CLO asset model, is publicly available for folks to download on dbrsmorningstar.com. Jerry, maybe next you can touch upon how this model might apply to warehouses, if at all.
Yeah, sure. So for each of these expressions in a matrix covenant, we will apply our CLO methodology. So that means the first step is we'll apply our predictive model. And so the output from that predictive model will be a stress portfolio default rate that's particular to that stage in the ramp up. Then we will conduct our cash flow analysis. So that's where we apply our cash flow assumptions from our cash flow methodology. And then once we apply the cash flow assumptions to the remaining assets after the stressed portfolio default rate is applied, if the losses on that tranche, if the losses on that tranche don't exceed zero, so the losses, once you apply all of those elements, then we would be able to assign a rating that's requested. That mechanic of stress portfolio default rate, cash flow analysis, and then comparison to see if there's any losses on the proposed rated tranche, that analysis is repeated for every step in the covenant matrix. So that way, essentially, like I said from the beginning, we are essentially just applying our base CLO methodology to each permutation of the proposed structure as it's ramping up. The usefulness of this technique is that if you have a covenant matrix, we can look into the future on what the portfolio could be and provide a rating much earlier in the process than waiting to have the fully ramped portfolio. So those covenants are obligations of collateral managers. So a rating agency like ourselves can actually rely on that to provide a rating. So that means that a set of covenants can earn a single rating that we would assign at the beginning of the process that would carry through the duration of the entire transaction. So despite the fact that the portfolio composition is changing over time, despite the fact that the leverage is changing over time, it might be possible if the covenant matrix is designed in a particular way for us to say that risk might always be a particular rating level, such as a single A. And for me, that's a very logical thing to think about, because a single A risk might be appropriate at maybe a much lower leverage level, like you see here, for a lower diverse portfolio, and perhaps there might be more leverage permitted if there's greater diversity or higher credit quality or other higher elements that might support that higher rating later on. So kind of tying all of these things together with these changes that you see in this graph over time, the type of analysis that we would apply is just quite simply looking at every different possible permutation and applying our CLO analysis. And the result of that would be a single rating on an instrument that grows over time on both the CLO warehouses as well as the CLO warehouse-like facilities.
Thanks, Jerry. Well, over the past few years, we have seen new structures starting to appear in the market that fall between transaction structured finance and corporate analysis, blurring the lines quite a bit. Middle market fund related ratings, I think, fall into this category. Maybe you can walk us through what a middle market fund related rating is.
Yeah, sure. Absolutely. So a middle market fund related rating is a rating on debt issued by a middle market fund, or it could also potentially be rating an instrument whose underlying asset itself is an LP interest in a middle market or direct lending fund. So this tool has emerged recently as another alternative for funds to either raise leverage or to syndicate. And the types of covenants and collateral quality tests and eligibility tests that are normal and expected for structured finance related analysis, they're typically not present in this in this style of structure. So the analysis that we do is a little bit different than it would be for middle market CLOs.
And following up on that, Jerry, and looking at a typical fund related rating, what types of structures have come across our desks that DBRS Morningstar has been asked to analyze?
Yeah, so I think here's a kind of a visualization of these two structures that I just described. So you've got the middle market fund that's itself raising debt, and that's potentially rateable under our new secured debt to rated funds methodology, and repackaging of an LP interest within another SPV is another permutation that's often rateable under our methodology. So I think this is kind of a helpful visualization. And here you'll see that what you aren't seeing is specific assets pledged to an SPV, which makes this maybe a little bit different than either the syndicated middle market CLOs, the warehouses to those CLOs, and the warehouse-like financing that we talked about previously.
Jerry, we've covered quite a bit of ground. This brings us to our last discussion point. Let's finish with items DBRS Morningstar has identified that are important for investors to know.
Yeah, sure. So that this comparison here between the structured finance related transactions, the CLOs and the warehouse-like facilities, and these fund-related ratings, there's a couple of key distinctions. For the for the structured finance related ratings, the covenants and the concentration limitations create very specific boundaries on the type of collateral that might be originated into such structures. So it gives ourselves comfort in terms of certain greater certainty around what might be originated for us to be able to determine a stressed portfolio default rate. When you don't have those same guidelines, you have more manager track record and manager history that you're looking at to determine those ratings, and those elements are more prominent in the fund related rating. So a fund related rating, therefore, is a corporate rating from our perspective. It's more looking at how how a particular instrument might behave based on how the company itself might perform. It's different than a very asset-intensive structured finance rating, where we sort of know the boundaries or the limitations of what might happen, and it's not based on qualitative considerations like manager history. As a result, because there's greater certainty for the structured finance type ratings than the corporate ratings, typically you would be able to see that for similar or very equivalent portfolios, that you might be able to achieve a higher rating or higher leverage on the structured finance transactions versus the corporate ratings. Those higher that's permitted because there's greater certainty around what those portfolios are going to be originated into, rather than the fund methodology. So under the fund methodology, there are typically fewer constraints that we need in order for us to conclude our analysis. So that might lead to greater management flexibility in terms of what to originate. But the ratings that you can achieve and the leverage that you can achieve under that are much lower. So that means the leverage can be different, as we're kind of highlighting here on the slide. The investment management flexibility can be different. And those rating methodologies are two separate methodologies. But what is similar across the two is we'll still use a CLO-like analysis to analyze what the assets might, how the assets might perform within that fund-related structure. The inputs there just aren't driven by specific collateral quality tests and concentration limitations. They might be developed based on a manager performance or manager historical behavior. So as a result, we've got a structured finance rating versus a corporate rating.
Thanks, Jerry. This concludes our prepared remarks for the Middle Market CLO 101 webinar on warehouses and financing facilities. Now we will open the discussion for Q&A. Again, you should see a question mark on either the right side of your panel or perhaps on the bottom, where you can click on the question mark and type out your question. I think I saw a couple come through. Let me just check here. Hold on. Okay, who are the different issuer types that sponsor these structures?
Yeah, they're actually the same issuer types that are sponsoring these. So it's typically middle market fund managers who are looking for leverage, and they're looking either in a club or a syndicated form. So from the middle market syndicated CLOs to the CLO-like financings to the fund-related ratings, they're all middle market lenders who are essentially raising funds.
Okay, great. Hold on, let me see. Okay, what is the process for obtaining a fund rating versus a CLO rating?
Yeah, sure. So applying essentially the difference is that we applied two different methodologies. So we applied the CLO methodology for middle market CLOs or warehouse-like facilities. And for the fund-related ratings, we apply the fund methodology rating. The analysis for the CLOs relies heavily on eligibility criteria, collateral quality tests, and concentration limitations. So that covenant matrix is really a primary driver of the rating. Although the other three pillars for that for analyzing those structures are going to be legal, operational risk, and counterparty risk. So that operational risk element has some ties, and the asset analysis has some ties to the fund related analysis, because in the fund analysis, the operational related element really expands tremendously to be a review of the fund manager itself, its history, and that fund manager review drives some of the primary inputs to the fund methodology rating. So it kind of highlights that the documents that are prescribing the guidelines for the structured finance ratings are going to be much more important than in the fund ratings, where a fund manager performance is going to be a much more important input.
Just check to see if any last ones came through. What type of funding sequence for these less diversified structures seem to be most prominent?
Yeah, sure. So typically for the less diversified structures, equity is used to fund first. So that's because for the very lowest diverse portfolio, so when there's one, when there's two, when there's three assets, there might not be enough diversity for a rating agency to be able to rate any amount of that structure with a meaningful rating. So typically, equity will fund first and then debt. Although we've seen a variety of proposals where once a base amount of equity has been funded, that there's either pro rata funding or a version of pro rata funding up the capital structure. But the most common that we would see is a reverse sequential structure.
I saw another one come through. What is the outlook for middle market CLOs in 2022?
Yeah, so this year was a very busy year for the syndicated middle market CLO space. I imagine the outlook for next year is probably going to be either similar or even potentially smaller, just given the the huge amount of dry powder in the middle market space. What I think is going to be more prominent, though, is these private CLOs and these club syndicated structures. They're really gaining a bit more prominence. So I think we'll see more of those, and I think we're going to see a lot more of these fund-related type structures as well. So maybe bridging the gap with this increase in the variety of types of financing options to middle market lenders. My personal prediction is to see at least a similar, maybe slightly smaller syndicated middle market CLO space and greater use of some of these other alternative structures.
Hold on, I see questions are coming through, Jerry. Hold on. How does a fund manager's performance history track record inform the ratings on securitized tranches? Can you describe at a high level the qualitative and quantitative framework around it?
Yeah, sure. For securitized tranches, meaning for middle market CLOs and the CLO warehouses and warehouse-like financings, the manager's performance history is less relevant to our analysis. So it does play a role because one of the key pillars of our analysis is operational risk. Operational risk primarily focuses on the manager's ability to abide by the eligibility criteria, collateral quality tests, and concentration limitations, and other rules embedded in the CLO. But we also do look as a secondary matter at the manager's performance history to make sure that the types of restrictions and guidelines that they're covenanting to within the CLO transaction are something that makes sense given their prior performance history. So for CLO-like structures, it's a consideration, but not as important a consideration as it would be for fund-related ratings. So for fund-related ratings that don't have those guidelines, the manager performance is much more important. So having longer performance history, having more consistent transaction history, these are all really key components for the fund-related ratings. The manager performance is a primary input on the fund side. So quantitatively, we're going to be looking to see that there is consistent and reliable information that we could use to project a stressed portfolio default rate in funds. So it's a much more important consideration for fund-related ratings.
Let me just check. Okay, I believe we have addressed all the questions posed. We want to thank each and every one of you for taking time out of your day to join us. And a very special thank you to Jerry for spending his afternoon with us. We hope that everyone found part 2 of our Middle Market CLO 101 session on warehouses and financing facilities helpful. This webinar is being recorded and will be available for playback should you wish to revisit any discussion points or perhaps share the replay with friends and colleagues. And as a reminder, part 1 of this 101 is linked below and is also available for playback at your leisure. Thank you again for joining us and have a great rest of the afternoon.
Thanks, everyone.